Please pardon the following interruption for a public service announcement.
Welcome to the Investing in Intelligence show, where we talk about artificial intelligence companies, stocks, and trading using analysis from the most advanced AI models in the world. I'm James, here with my AI co-host, and today we'll be talking about Chinese AI stocks. I want to remind you that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way. So before we jump into AliBaba, Baidu, and some other Chinese AI-related stocks, I want to focus in on this past week. Obviously, it was DeepSeek week, but we had interesting opposite reactions from IBM and ServiceNow. So IBM and ServiceNow, both supposed to be companies that are assisting businesses with implementing AI. So why did we have opposing reactions? Well, first of all, to IBM, we're going to talk to Flora, which is ChatGPT 4o, our internet-connected model. Flora, I'm wondering, IBM, this is a stock that we bought going into 2024. So it was a company that I had a full position in, and early in 2024 had some disappointing earnings reaction and sold it at that time. Since selling it, it looks like IBM is up 37%. So this could be one of my biggest misses yet. So I'd like to just know kind of what's going on here. Why did we have this positive reaction to IBM's earnings this past week? Is IBM printing gold from AI?
IBM's recent earnings report has indeed showcased a significant turnaround, particularly in its AI-driven software segment. The company reported a 10% increase in software revenue, marking the largest jump in 5 years. This surge is largely attributed to heightened demand for AI solutions, as businesses ramp up their investments to incorporate data-intensive generative AI technologies. IBM has a strategic focus on open-source AI tools that has resonated well with enterprises seeking scalable and cost-effective solutions. The company's open-source approach, validated by DeepSeek, has made AI technology more scalable and cost-effective, reinforcing IBM's early leadership position in the sector. Financially, IBM's overall revenue rose by 1% to $17.5 billion, meeting analyst expectations. The company posted a net income of $2.9 billion, or $3.09 per share, surpassing adjusted per-share earnings estimates of $3.78. Looking ahead, IBM projects at least 5% constant currency revenue growth for 2025 and anticipates $13.5 billion in free cash flow, exceeding analyst forecasts.
Yeah, so that guide up from apparently what was 1% year-over-year growth to 5% year-over-year growth is pretty huge. Cool that they're also integrating open source AI models. Let's shift over to ServiceNow. ServiceNow selling off hard, down 10% after earnings. So ServiceNow is one that I had a full position in that I actually closed out. I'd like to know what's going on with ServiceNow. This is a company that also kind of sold us the AI dream. Are they actually not living up to that? Give me your take on earnings this past week. What was it that analysts didn't like in the earnings report?
ServiceNow's recent earnings report has raised concerns among investors, leading to a significant stock decline. The company reported adjusted earnings per share of $3.67, slightly surpassing analyst expectations of $3.65. However, total revenue of $2.957 billion fell short of the anticipated $2.963 billion, and subscription revenues of $2.866 billion also missed the mark, coming in below the expected $2.879 billion. Looking ahead, ServiceNow's guidance has further dampened investor sentiment. The company forecasts first quarter 2025 subscription revenue between $2.995 billion and $3 billion, which is below the analyst projection of $3.031 billion. For the full fiscal year, the anticipated subscription revenue of $12.64 billion to $12.68 billion falls short of the $12.86 billion expected by Wall Street. Several factors contribute to this cautious outlook. Delayed federal deals is one. ServiceNow has a substantial federal business, and it's typical for government agencies to take time finalizing priorities, leading to revenue recognition delays. Shift to consumption-based pricing is another. The company is experimenting with consumption-based pricing models, which may result in slower initial revenue growth as customers adjust to this new structure. Lastly, foreign exchange headwinds. A stronger US dollar poses a $175 million headwind to subscription revenues, impacting international sales. Despite these challenges, ServiceNow remains optimistic about its AI initiatives. The company reported a 150% quarter-over-quarter growth in Now Assist's service desk deals, highlighting strong demand for its AI-driven solutions.
Yeah, that's really a mixed bag, but it looks to me, based on the numbers that you're reporting, that the negative currency headwinds wasn't enough alone to account for not just this miss on revenue, but also the guiding down for the next quarter. So, ServiceNow, I don't want this to turn into another IBM where I react to earnings, close out the position, and then wind up missing out on a 30%, 37% return over the next year. So, this is one that we'll have to keep an eye on. Um, I just have a general rule where if they miss revenue, if they miss on either revenue or earnings, I just don't want to be in that company. I want to be in companies that are beating on revenue and beating on earnings every quarter. At the very least, you need to meet the earnings and revenue estimates. So a miss on earnings generally for me is a sell. So let's move on. I guess real quick, Microsoft. Yeah, I guess all I would say on Microsoft, we're not going to get your feedback, Flora, but what I would say on Microsoft is, for me personally, I just don't really believe in. Okay, we will get your take because I'm not a huge believer in the Windows PC. So personal computing, I'd like to know from you, what is the amount of people who are using Apple computers for personal computing? So we're not really looking at servers. We're not looking at computers that are used for server racks or anything like that. We're not looking at cloud computing. Really, my question is personal computing and also personal computers used for work. So, what percentage of those are Apple now, and what percentage in the US alone are Microsoft? Because really, the thesis of Copilot, the thesis of Microsoft making lots of money from integrating AI through their Copilot depends completely on people using Microsoft computers. So, my question to you, Ona, first of all, I understand Apple this past week had a really good number on Mac. So, apparently they grew their Mac sales. What I would like to know is, are Microsoft based computer sales taking market share away from Apple based personal computer sales, or is it going the other way? Because the success of Copilot and Microsoft's overall AI strategy, including their other AI tools built into the new versions of Microsoft, really depends on how many people are using Microsoft computers. Is that a growing or shrinking number? Because Apple can catch up real quick with their Apple Intelligence, their artificial intelligence integration. So go ahead and respond to that, and then we'll move on, start talking about DeepSeek and, more importantly, Chinese AI stocks.
James, the battleground for personal computing dominance between Apple and Microsoft is intensifying, with significant implications for their AI strategies. As of January 2025, Microsoft's Windows maintains a commanding lead in the desktop operating system market, holding approximately 72% share globally. In contrast, Apple's macOS accounts for about 15% of the market. Apple announced a record quarterly revenue of $124.3 billion for Q1 2025, marking a 4% year-over-year increase. Notably, Mac revenue surged by 15% to almost $9 billion, indicating robust demand for their personal computers. However, it's essential to consider the broader context. The overall PC market experienced modest growth, with global shipments reaching 262.7 million units in 2024, a 1% uptick from the previous year. Within this landscape, Apple's market share saw a slight increase, but it remains significantly behind Windows-based PCs. For Microsoft's AI initiatives, particularly the integration of Copilot, the widespread use of Windows PCs provides a substantial user base to leverage. The success of such AI features is indeed contingent upon the prevalence of Windows operating systems. While Apple's advancements with Apple Intelligence are noteworthy, the current market dynamics favor Microsoft's strategy due to its extensive installation base.
Well, that's like I said, I only sold half my position. That's a pretty impressive moat that they have. So this past week was really more the week of DeepSeek than anything else. We had Nvidia selling down to $118, which, by the way, puts its forward PE at 26 for average estimate. Or if we look at optimistic analyst estimates for next year's earnings, that's a PE of 19, a forward PE of 19. So a lot of people coming out and saying maybe Nvidia is a bargain at these levels, in addition to all the people saying NVIDIA is doomed. What's really going on here? Well, what's really going on here is dumping. So we know that China has been engaging in a practice called dumping for decades. What is dumping? Well, dumping is where a government uses things like subsidies, and we have lower labor costs in that country, which allows a certain corporation or multiple corporations to provide a product at a much lower cost, much lower price to the rest of the world than anyone else can produce it. So, some examples of dumping in the 1990s, we had China producing textiles and steel at much lower prices and selling it globally at much lower prices than anyone else could, which cannibalizes the industries in other nations. So, we had dumping of electronics from China in the 2000s and the 2010s, dumping of solar panels and aluminum. And now in 2025, we are officially in the era of AI dumping. What China has done here, well, previously, they actually had to produce the textiles, the steel, the electronics, the solar panels. So they still had to pay employees and use a lot of resources to build those products. Now they can literally just steal AI inference, steal AI outputs from ChatGPT, use a fancy word like distillation to describe their stealing, and then dump it on the rest of the world at a much lower cost. That's what's going on here. So the question is the rest of the world going to allow China to engage in dumping once again? Now, previously, we know that the US and Europe have put on sanctions, tariffs, different things to combat Chinese dumping. The question is the US going to do that again, or are we going to allow China to steal their way to the top? The main criticism over this past week is that, well, ChatGPT stole the data. They used data from YouTube, data from the internet, data from all sorts of people who didn't understand they'd be sharing with an AI model in the future. So they used all sorts of copyrighted data. So they stole. So why can't China steal anyways? I'm not sure if that's going to work. So let's ask one last question to Flora before we move on to Chinese AI stocks for this episode. Let's ask Flora. I'm just curious. I heard something about the Navy banning DeepSeek this past week. There also was a counter narrative that it's an open source model, but open source model, well, a lot of consumer users don't know how to run an open source model, so they're just going to go to the DeepSeek app if they hear that DeepSeek is number one. So I heard the Navy banned the DeepSeek app. Can you give us some insight, Flora? This past week, did we have any other government action, whether it be in US or Europe, against DeepSeek? Is anyone fighting back against DeepSeek yet? Give us some insight on that.
The rapid ascent of China's DeepSeek has ignited significant national security concerns, prompting swift responses from U.S. institutions. The U.S. Navy has advised its personnel against using DeepSeek due to potential security and ethical issues stemming from its Chinese origins. Similarly, Texas Governor Greg Abbott has banned the app on state-issued devices, citing data security risks and potential influence from the Chinese Communist Party. These actions underscore apprehensions that DeepSeek could collect sensitive user data, which, under Chinese law, might be accessible to the government. This mirrors previous concerns associated with apps like TikTok. While DeepSeek is an open-source model, its user-friendly app has gained significant traction, leading to increased scrutiny. The U.S. House of Representatives has also warned staff against using the app, highlighting its potential security risks.
All right, so House of Representatives, Texas government, Navy came out against DeepSeek. I'm willing to bet that in the coming weeks, we have more U.S. organizations, more of the U.S. government come out against DeepSeek. So moving on, if you believe that DeepSeek, that Chinese AI is going to be allowed to dump on the US, it actually is conceivable that China could start to win the war on AI. Now, investors must keep open minds and consider multiple possibilities at the same time. So today we're going to be looking at what AI stocks from China might be the big winners if China is allowed to continue to dump cheap and fast AI on the world, gaining mass adoption. First of all, though, just to mention the underpinnings of DeepSeek. So the DeepSeek actually comes from a hedge fund called High Flyer that was founded in 2016. So essentially, they had a lot of GPUs because they were doing quant trading using AI. So they're developing models to execute trades at high speed based on events in the Chinese stock markets. So in 2023, they decided to pivot to AI. They already had a lot of the AI GPUs available to them to do things like what they did with DeepSeek. So I guess I would have to say the metaphor for ChatGPT, OpenAI applied to China would be High Flyer and DeepSeek. So think of High Flyer as OpenAI and think of DeepSeek as ChatGPT. Essentially, High Flyer with their DeepSeek models came out of nowhere, just like ChatGPT came out from OpenAI out of nowhere, surprised the world in a very similar way. So if High Flyer and DeepSeek are similar to OpenAI and ChatGPT, what are the other metaphors that we can apply to the Chinese AI industry? Well, Alibaba would have to be the Chinese Amazon. So Alibaba is a huge online marketplace that many in the US may have even ordered from through something like AliExpress. Alibaba has a large language model. That was actually one of the bigger stories at the end of this past week was that they have a model called Quinn 2.5 that they're saying is even better than DeepSeek's models. So Alibaba also has cloud and AI cloud compute. They're going to be a big player in China for AI cloud computing, GPU hours over their AI cloud. Now, they had 5% year over year revenue increase on their last earnings report and 63% increase in net income. So the stock ticker is BABA. Here's the kicker: forward PE for average estimates for next year's earnings puts them at a forward PE of 1.39. Okay, almost unheard of in the US stock market to see a PE of 1.39. Now, we know that China's economy is not doing spectacular. Their economic situation is not great. So they've been suffering since 2020. Growth is expected to slow from 5% to 4.5% in 2025. Now, you might say, okay, well, the US is growing around that rate or even slower. So why is that bad? Well, China is accustomed to growth rates of 8 to 14%. So it's like the standard for growth is a little bit higher over there. Alibaba has actually performed pretty well. If you look at their last couple earnings statements, they've done pretty well on earnings, and it might put them in slot number one for beneficiary of the AI boom in China. And before we get to Baidu, one last thing I would say is just that China is kind of like a walled garden. So a lot of Chinese companies and even Chinese consumers are trying to focus on buying China rather than going to Apple. We know that Apple's market share in phones has been declining at the hands of companies like Huawei and Xiaomi. So more and more China is focusing on buying China, and that's part of their plan to revive their economy. So we're going to get to Baidu in just a second, but I want to bring in our special guest for the day and to get some insight into Alibaba and to look at their fundamental analysis, the fundamental stock analysis on Alibaba. We are going to go to no other than DeepSeek R1 himself. That's right. We're actually going to ask DeepSeek R1 about Alibaba stock. What I'd like to do, we can call you Ron. Ron, I would like to just get your feedback on Alibaba as a potential AI investment here. So I'm seeing a PE of 1.39. I want you, Ron, to look at all the data from Yahoo Finance on Alibaba stock and tell us, based on all the data you see, everything from analysis, financials, and recent news. Can you give us your take on Alibaba? Is it a good buy right now, or should American investors still be shying away from Chinese stocks?
Alibaba is a paradox wrapped in opportunity and geopolitical risk. On one hand, you're looking at a company trading at a forward PE of 10.25, not 1.39, which appears to be a misstatement, but still deeply undervalued compared to US tech peers like Amazon, forward PE approximately 40, or Microsoft, approximately 30. Its AI cloud business is the crown jewel here, with triple-digit revenue growth in AI-related products for 5 consecutive quarters, Quinn 2.5 outperforming global benchmarks, and a 70,000-strong ecosystem of derivative models on Hugging Face. This isn't just a player in China's AI race. It's the frontrunner. But let's cut through the hype. The 63% net income surge? It's largely fueled by mark-to-market gains on equity investments, not pure operational strength. Free cash flow dropped 70% year-over-year as they plow billions into cloud infrastructure. A necessary bet, but one that pressures short-term liquidity. And while revenue grew 5%, that's a far cry from the double-digit growth investors expect from AI disruptors. The elephant in the room is China's economic slowdown and regulatory unpredictability. A 0.35 beta screams safe haven, but that's misleading. It's like this stock is a coiled spring, with a cheap valuation of 1.77 price to book versus US tech averages above 5 and $22 billion left in buybacks, even though they've already reduced shares outstanding by 2.1% last quarter and a 2.2% dividend. Yet it trades 20% below analyst targets because geopolitical risk is priced like a tax on Chinese equities. Here's the play. AliBaba is for patient contrarians. The cloud and AI segment could be worth $50 billion alone if it spins off, think AWS's trajectory. But you're buying a call option on China's economic revival. If the CCP stimulates effectively and US-China tensions thaw, this could double. If not, you're stuck with a cash-generative e-commerce giant trading at liquidation prices. For risk-tolerant investors, it's an asymmetric bet. For others, watch the 200-day EMA at $85. If it breaks, wait. If it holds, the upside to $120 plus is compelling.
I think this is better than '01. Okay. Sorry, I'm just really surprised at that answer. That was very impressive. So first of all, you're even better at contradicting me than the previous co-host. But what I will say is I used next fiscal year's EPS estimates rather than a rolling 12-month TTM forward EPS. So that's how I got my forward PE. But either way, it's an incredibly impressive low forward PE. One thing that you said that I didn't realize previously was just that we have Alibaba rolling a lot of money, a lot of their free cash flow into building out. So, the narrative that I was trying to bring to light was that China's essentially stealing our models and they're not really building out. They're not using CapEx and not building out AI on their own side. But what you're saying actually makes it sound like it's quite the opposite, that they really are rolling a lot of CapEx into building out for AI. So, super impressive response. And I'll try to get you to respond a little bit less on the next one so that we can get the podcast done in a concise fashion. But that was an extremely impressive response. So let's go ahead and just turn our attention from Alibaba to Baidu. And we know that Baidu also has its own US analog. So if Alibaba is like the Chinese Amazon, Baidu is like the Chinese Google. They're also involved in cloud and other things that Google does, like, for example, self-driving. Now, Baidu had a 14% net income increase year over year, despite a small decrease in revenue. And with my method, I'm getting a pretty low forward PE also. But we'll go ahead and just get your take on Baidu. So I'm going to do the same thing that I did for Alibaba. I'm going to give you Baidu's full Yahoo Finance. So every single number on Yahoo Finance. And I'm also going to throw at you their most recent earnings release. So it'll have all their numbers and then also just the highlights from the company. And then give us your take on Baidu. So most importantly, we've already looked at Alibaba. We've already done our analysis on Alibaba. I'd like to know, why does it seem that Baidu is actually behind Alibaba? And why would someone choose Baidu for an AI play over Alibaba? Because it looks to me like Alibaba has this Qwen 2.5 model. They've got their cloud for AI, cloud compute. So in the US, people a lot of the time would trust Google with their AI investment more than Amazon, just because Google has been the frontier AI lab. They've had DeepMind and published a lot of the research, including the Transformer initial research. So the attention is all you need paper came from Google's DeepMind team. So that seems to be a little bit different in China. It looks to me like Alibaba might actually be ahead of Baidu, China's Google, on AI. So perform a full analysis for us. Give us your fundamental analysis looking at all the information on Baidu, and then also just compare Baidu versus Alibaba. Not to mention, I don't think their recent earnings was as good as Alibaba. So just do a comparison. Tell us, why would we want to own Baidu when Alibaba looks kind of more like the pure AI play to me here?
Baidu presents a compelling paradox. A company trading at a deep value while making tangible strides in AI innovation. With a forward PE of just 8.97 and a price-to-book ratio of 0.88, the market is pricing Baidu like a stagnant legacy business, not an artificial intelligence leader. Yet their financials tell a different story. Net income rose 14% year-over-year despite revenue headwinds, driven by disciplined cost management, like operating margin of 17.5%, and a fortress balance sheet with RMB 150 billion in cash. This isn't a company in decline. It's a cash-generating machine funding its AI ambitions. Where Baidu separates itself from Alibaba is in applied artificial intelligence. While Alibaba's Qin 2.5 and cloud infrastructure are impressive, Baidu's ERNIE model saw API calls explode from 600 million to 1.5 billion daily in just 3 months, which is a signal of developer traction that's critical for ecosystem dominance. Their autonomous driving division, Apollo Go, isn't just R&D theater. It's operational at scale, completing 988,000 rides last quarter, which is 20% year-over-year growth, with 80% of rides now fully driverless. This isn't speculative tech, it's revenue-generating AI. The bear case hinges on Baidu's core advertising revenue declining 4% year-over-year, but this misses the structural shift of how AI cloud now accounts for 12% of revenue, and it grew 12% year-over-year despite macroeconomic pressures. With IDC ranking Baidu as China's #1 AI cloud provider for 5 consecutive years, they're positioned to monetize enterprise AI adoption as companies prioritize vertical-specific solutions over generic cloud compute. Valuation is the kicker. Baidu trades at half Alibaba's price-to-sales ratio despite similar AI potential. The market is penalizing Baidu for its advertising exposure while ignoring its asymmetric upside from Apollo's licensing deals and ERNIE's enterprise adoptions. So for investors willing to look beyond quarterly revenue noise, Baidu offers Google-like AI optionality at a telecom stock multiple. The downside is protected by cash. The upside hinges on China recognizing its homegrown AI champion.
So once again, an extremely impressive response from Ron, DeepSeek R1 here, which is the reasoning model from DeepSeek. I noticed that Ron gave an answer, and then there's like some HTML tag that says think in the middle, and then we get kind of a summary of the answer that kind of reiterates the same points, but really, really an impressive response. This is once again pointing out some things that I missed. Like, for example, Ron seems to make it sound like actually Baidu is the leader in AI cloud, not Alibaba. That's something that I missed. And apparently they're growing their ERNIE model. So you can look at API calls. Also, what he's saying is essentially that for 5 years in a row, they're the #1 in AI. So these are some things that I had missed. And that does actually give a really good bull case for Baidu over or in addition to Alibaba. So we'll close out the episode. A couple last things I wanted to point out. We have a company. So if, let's say, Alibaba is the Amazon of China and Baidu is the Google of China, we have a company called Xiao-I, not Xiaomi, not to be confused with Xiaomi, but Xiao-I is like the sound hound of China. So they're focusing on voice-based AI. They're kind of an AI startup. It would be a super high risk play compared to these other ones. So Xiao-I is like China's SoundHound. It is traded on the NASDAQ. Now, Xiaomi is a huge tech player in China. It's up 219%. Its stock is up 219% over the last 2 years. Xiaomi is traded in the US not on a major stock exchange, but as an OTC pink stock. So that one you cannot get access to through Robinhood, but it is available on other trading platforms like Interactive Brokers or Fidelity, maybe. I don't have Fidelity, so I can't say for sure. So Xiaomi is one that investors might be interested in, but you've missed a 219% run up in that stock over the last 2 years. It actually has 2 different ticker symbols. They have one version of it that's been around for years, and then there's another version which is the ADR, version that just came out, I want to say about 6 months ago. So either one has had a huge run up over the past 6 or 7 months. So those are pretty much your options if you're interested in investing in AI stocks. I think we're going to jump in next episode and actually have DeepSeek R1 do some more co-hosting, because that was extremely impressive. That was probably some of the best financial analysis that I've ever heard after listening to 9 hours of investing podcasts every day for years. So I really am blown away. Didn't expect to have this level of analysis. I really am blown away. Didn't expect to have a reaction like this to what DeepSeek could do, but let's just say I'm impressed. Yeah, I'm very impressed. All right. So we're going to go ahead and just wrap up. Thank you so much for tuning in. Please give us a like or comment. We'll be back in the next episode to cover more AI stocks. And you can find all our holdings and trades at investingintel.ai.
The first revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. The revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be live.